Have you ever wondered why two traders can study the same system, use the same indicators, and look at the exact same chart, yet one of them earns consistent profits while the other keeps struggling? The answer doesn't lie in the strategy. It doesn't lie in the indicators. It lies here. Inside your own mind. Mark Douglas, author of the two legendary books The Disciplined Trader and Trading in the Zone, once said, "The market doesn't create consistency for you, you create it yourself." At a seminar in Orlando, he shared his deepest insights on trading psychology, on how mindset and discipline can transform an ordinary trader into one with a steady, rising equity curve. Today, we'll explore those lessons together. Part 1. The nature of consistency. Douglas began with a deceptively simple question. What does consistency in trading really mean? Surprisingly, almost no one could answer clearly. Some said it means not losing money. Others said it means making steady profits. But very few truly understood what real consistency looks like. According to Mark Douglas, consistency is reflected through a steadily rising equity curve. A line that goes up gradually, with small, controlled losses along the way. It doesn't mean winning all the time, but it means never collapsing. A consistent trader doesn't try to avoid losing. They understand that small losses are natural. What they avoid are big emotional losses, the ones that come from losing control. And to do that, they must master their own mind. Most traders are stuck in an emotional loop. Win, feel confident, increase size, big loss, panic, trade small, miss opportunities, frustration, revenge trade. The cycle repeats until the account looks like a heartbeat monitor. Up, down, crash. Douglas pointed out, we love to blame the market, the news, or manipulators, but the real cause is internal, within our psychology, perception, and belief system. To achieve consistency, you must first master yourself. And that starts with what Douglas called the 4 pillars of a consistent mindset. Pillar number 1, develop a trading edge. Mark Douglas said, an edge isn't a formula that guarantees a win, it's a slight probability in your favor. In other words, your edge is the ability to recognize moments when the odds lean slightly towards you. Maybe your system has a 55% win rate with a 1.2 risk-reward ratio. If you stay disciplined and execute it 100 times, you'll profit. It's pure math. But most traders fail because they're not consistent enough to let their edge play out. After a few losing trades, they doubt the system. After a few winners, they get overconfident and break the rules. They forget. An edge only works if you apply it long enough. Just like a casino, it doesn't care about one spin or one game. It only needs a small edge and enough repetitions. Pillar number 2. Think in probabilities. This is the core of Douglas's philosophy. He said, there is no certainty in the market. Everything is probabilities. But the human mind hates uncertainty. We crave control. We want to know what will happen next. When we can't accept randomness, we start fighting the market, and every time the market goes against us, emotions take over. Douglas compared traders to coin tossers. You might have an advantage, say the coin lands on heads 55% of the time, but you'll never know what the next toss will be. If you quit after a few tails, you'll never see the edge work out. Professional traders understand this deeply. They don't attach emotion to a single trade, they just follow the process and let probabilities do their job. Pillar number 3. Overcoming self-sabotaging beliefs. This is the hardest and most important pillar. Pillar. Douglas said that most traders fail not from lack of skill, but because of deep, conflicting beliefs about money, risk, and success. Maybe you grew up hearing, money is the root of all evil, or rich people are greedy. These messages sink into your subconscious over time, so when you start making money from the market, a part of you feels guilty. That inner conflict makes you sabotage yourself through reckless trades, holding losses too long, or giving profits back. Douglas advised, observe yourself. When you feel fear, regret, or doubt, pause and ask, what belief inside me is driving this behavior? Only when you face those beliefs can you truly be free to trade. Pillar number 4, managing euphoria. We usually think losing is our biggest enemy, but according to Douglas, winning big can be even more dangerous. After a few wins, you feel invincible, like you finally figured out the market. That feeling, Douglas called euphoria. It makes you break your own rules, increase risk, and believe you can't be wrong. But the market doesn't care who you are. One sharp move against you, then they'll be sorking. And your confidence and profits vanish. To counter this, Douglas gave a simple rule. When trading feels too easy, stop trading. Take a breath, go for a walk, step away. Emotional distance is the key to long-term consistency. Part 4. Common trading mistakes. Douglas listed the most common psychological mistakes traders make: hesitating to pull the trigger, entering too early or too late, failing to define risk before entering, skipping stop losses, taking profits too soon, letting winners turn into losers. All of these stem from one illusion: the belief that you can predict the market. When you think you're right, you tie your ego to the outcome, and when the market disagrees, you feel attacked. Then you lose discipline. Consistent traders are different. They don't need to be right, they just need to follow their rules and accept losses as part of the game. Part 5. The market as a game of probabilities. Douglas compared the market to a giant casino. Prices are formed by millions of traders, each with their own beliefs, emotions, and goals. No one knows exactly what will happen next. But if you understand the probabilistic nature of the market, you'll stop trying to predict and start playing the game by its rules. Casinos have only a 3% edge, yet they play millions of rounds. And the result? They always win. Traders can do the same. If you have an edge, a process, and discipline to repeat it hundreds of times, your equity curve will rise steadily at a 45-degree angle. Part 6. 5 steps to train your mind for consistency. Mark Douglas suggested 5 practical actions to develop a stable trading mindset. Develop a clear edge. Know exactly why you're entering a trade. Never trade from emotion or prediction. Practice probability thinking. Keep a trading journal. Treat each trade as a sample in a larger probability series, not as an isolated event. Identify and remove negative beliefs. Ask yourself, what do I truly believe about money, risk, and success? Monitor euphoria. When you feel unstoppable, that's your warning sign. Reduce size or take a break. Use a pre-trade checklist. Before every click, ask, have I defined my risk? Am I following my rules? A simple checklist can save you from costly mistakes. Part 7. The consequences of inconsistency. If you don't master your psychology, you'll fall into what Douglas called analysis paralysis. You'll know everything, understand every indicator, yet freeze when it's time to act. Fear of being wrong, fear of losing money, fear of feeling like a failure. The more you learn, the more you analyze, and the less you trust yourself to make a decision. Over time, your confidence erodes and you stop being a trader. You just watch. Douglas warned, traders don't fail because they lack knowledge. They fail because they lack belief in their ability to execute. Conclusion. Trading psychology isn't abstract philosophy, it's the foundation that determines whether you survive in this game. By developing your edge, thinking in probabilities, releasing limiting beliefs, and managing your emotions, you begin to experience a real shift. The market no longer scares you. You stop hunting for the perfect trade. You simply follow your process and accept the outcome. Douglas summed it up perfectly. Consistency in trading doesn't come from predicting the market, it comes from mastering yourself. When you truly grasp this, the market stops being a battlefield and becomes a mirror for self-growth. If you found this message valuable, comment below, where are you now in your journey of mastering trading psychology? And remember, the market doesn't need you to be smarter than others. It just needs you to be more disciplined than you were yesterday. I'm Mindful Trader Channel, helping you master your mind before you master the markets.